This podcast is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional. Welcome to the Deep Dive. We've gone through a huge stack of recent market research and analyst reports to put together this recap for you. Our goal here is to really cut through the noise, filter out the hype, and give you just the core data points and the key insights that are shaping big tech, macro liquidity, and the crypto space right now.
Yeah, and the big picture, the main story right now, is one of, I'd say, focused opportunity that's being driven by really high volatility.
Okay, so it's not just random chaos.
Not at all. The market is being pulled by three very clear forces. First, you've got this fierce competition heating up in the AI chip sector. Second, a total dependence on what the Federal Reserve might do next with liquidity. And third, there's some critical technical levels that are basically drawing the lines in the sand for the big indexes and for digital assets.
Okay, so let's start there with the short-term market movements. The sources we looked at describe this very specific, almost predictable daily pattern.
They do. It's a really distinct rhythm.
We're seeing these heavy sell-offs early in the trading day. Some analysts are calling it sellers in control at the open. But then it's followed by these pretty big reversals in the mid to late afternoon.
That intraday pattern is so important to watch. It tells us that while there's definitely some morning pressure, maybe it's algorithms unwinding positions or big institutions executing sell orders,
Right.
the underlying demand from buyers is still strong enough to consistently push everything back up by the close.
So if you get spooked by those early morning drops and sell, you're probably missing the recovery.
You're almost certainly missing the bounce. That's where the data shows the buyers are consistently taking back control. It's like the first half of a game versus the second half.
So the message isn't just a simple buy the dip. It's more about understanding when the dip is most likely to happen.
Exactly. The dip seems to be scheduled, in a way, for the first couple of hours of the day. And we saw some really specific strategies mentioned, like using short-term put options on the SPY to actually profit from that morning downturn.
And then flipping that position to catch the afternoon rally.
Precisely. It's all about timing. And that precision is even more critical right now because we are heading into a holiday-shortened trading week.
Okay, good point. The Thanksgiving holiday.
Right. You've got a full day of trading today, but then the market's closed on Thursday and it's only a half day on Friday. So that window you have to manage your risk, it gets really, really compressed.
So you can't just let a volatile trade ride.
You absolutely cannot. You have to be ready to secure your profits quickly because you can't count on having a full day to get out if things, go sideways right before the holiday.
Okay, this is a perfect pivot to what's probably the biggest fundamental story out there, the one driving the next decade. The AI chip war.
It is massive.
And it's not just chip makers fighting each other anymore. The sources are showing how tangled this has all become. You have Nvidia, Meta, Google. They're all competing, but they're also customers of each other.
It's a very complex ecosystem now. And the main point of tension, the real drama, is centered on Meta. They are one of the biggest consumers of AI computing power on the planet, and where they decide to spend their money is a huge deal.
And the reports are confirming they're looking at alternatives to Nvidia's GPUs.
That's right. Specifically, they're looking very seriously at using Google's own proprietary tensor processing units, or TPUs.
And this all comes down to money, I assume. What kind of cost difference are we actually talking about here?
We are talking about a staggering difference. It's what makes this competition so aggressive. The numbers suggest that Google's TPUs could save Meta anywhere from 4 to 10 times the money compared to running the same AI jobs on cloud-based Nvidia hardware.
4 to 10 times.
Yeah. I mean, to put real numbers on it, using Nvidia's chips in the cloud might cost Meta something like $3 to $10 per hour. Google's TPUs, because they're custom-built for these huge AI tasks, are estimated to cost as little as 84 cents per hour.
Wow. Okay, and when you multiply that by millions of hours of computing time?
You're talking about billions of dollars in savings. Billions!
So if the savings are that enormous, why is this even a question? Why would Meta, or anyone for that matter, even consider sticking with Nvidia?
That's a fantastic point, and it gets to the heart of the strategic risk here, which is vendor lock-in. Google's TPUs are amazing, but they're custom-built for very specific things. They are not universal.
Okay, so they're specialists.
Exactly, and Nvidia's whole counter-argument is that they are, and this is their quote, a generation ahead in performance, but more importantly, in versatility, or what they call fungibility.
So Nvidia is selling themselves as the Swiss Army knife, even if it costs more to use.
That's the perfect analogy. NVIDIA's claim is that their platform is the only one that can run every single AI model anywhere without the limits you get with specialized hardware like TPUs. They're betting that this universal compatibility, plus their huge software ecosystem, justifies that premium price.
The argument being that flexibility is worth paying for, so you don't get trapped with one specific type of hardware.
Precisely. It's a huge strategic bet on their part.
All right, let's translate this into what investors are actually looking at. What are the key numbers and valuations for these companies? Let's start with Nvidia. I know Morningstar had some interesting targets.
Yeah, so NVIDIA's been trading in a pretty clear channel, bouncing between roughly $170 and $200 a share. But Morningstar's research puts a much higher fair value on it, targeting $240.
Okay, so significant upside potential there.
Potentially, yes. But what's really eye-opening about NVIDIA is its operational efficiency. It's a mind-blowing metric. They generate an incredible $3.7 million in revenue per employee.
3.7 million
Yeah.
per employee. How is that even possible for a company that big?
Well, it tells you that NVIDIA isn't really just a hardware company anymore. It's fundamentally a software and intellectual property company.
Oh.
That kind of revenue per employee points to an extremely high-margin business model. It's driven by IP licensing, proprietary software, controlling that whole ecosystem around the chips. Not just by, shipping boxes of hardware.
Yeah.
That's why analysts see any price under $169 as a strong buy, and the current range is still fair.
Okay, so that's Nvidia. Now, what about Meta? The valuation picture there, according to the data, looks even more compelling, almost lopsided.
It really does. Meta's currently trading at a low forward price-to-earnings ratio, a forward PE of just 21.
And for a high-growth tech company, that's low.
It's very low. For context, in this sector, analysts usually want to see a forward PE somewhere in the 30 to 35 range. So Meta's trading at a significant discount to its peers. And Morningstar's fair value target for Meta is, well, that's huge. They're suggesting a long-term target of $850.
$850.
Yeah.
That's nearly double where the stock is trading now. Why is there such a massive disconnect?
The thinking is that the current low valuation just isn't factoring in Meta's deep capacity for revenue growth, especially as they start to really monetize the metaverse infrastructure and as their core advertising business continues to stabilize and grow.
So the market is being too pessimistic?
That's the argument. That's why many analysts see the stock trading anywhere in the $500 range as a substantial discount. Some even called it a steal, given that underlying potential and that $850 fair value target.
Okay, that gives us a really clear view of the micro-level competition. Now let's zoom out and connect this all back to the macro environment, the liquidity picture that really impacts all risk assets, which of course includes our next topic, crypto.
Yes, and that macro uncertainty is still front and center. Right now, a lot of the market's attention is on who might be chosen for the incoming Federal Reserve leadership.
And what's the market hoping for?
Well, the sources suggest that the market would react most positively to a pick who is seen as strongly in favor of a very accommodative policy. We're talking about the kind of policy that would mean quick rate cuts, maybe even stimulus measures, anything that prioritizes getting more liquidity into the system.
So in the short term, the market just wants the taps turned back on, even if there are longer-term inflation risks that might come with that.
That's the signal, yes. And if we do see those rate cuts, some sources are speculating maybe as early as December or January, that flood of liquidity is expected to be a massive tailwind for all risk-on assets.
More money in the system looking for a home.
Exactly. More money chasing higher returns, which usually means high-growth tech stocks and, of course, digital assets. This leads us directly to Bitcoin and the crypto market, which is incredibly sensitive to these global liquidity shifts.
So let's get into the technicals for Bitcoin. It's been a volatile ride recently. What are the key levels that have held up, and what price are analysts watching for to confirm a real bull run?
So Bitcoin recently broke down through its prior support floor, which was holding around $92,000. That was a bit worrying.
But it found its footing.
It did. The good news is that it successfully defended the next critical consolidation floor, which is between $81,000 and $83,000. Holding that level was key to preventing a much deeper pullback.
So what's the next big hurdle? The level that would signal a major acceleration?
The number everyone is watching for is in the $150,000 to $200,000 range. For analysts to really get bullish and call the start of the next major leg up, they need to see Bitcoin decisively break through that resistance zone.
And that long-term target is, of course, all tied into the fundamental rhythm of Bitcoin's 4-year cycle, the halving.
It's still the dominant pattern. That 4-year cycle tied to the Bitcoin halving when the mining reward gets cut in half, it remains the key predictive model. The next one is expected around May 2024.
Okay. And historically, the cycle peak doesn't happen right away.
No, not at all. Historically, the peak of the bull run that follows tends to happen 12 to 18 months after the halving event itself. So if that pattern holds, this model would place the next potential major market top sometime in, say, the first quarter of 2026.
And beyond just the price cycles, there's a huge structural shift happening in how bigger, wealthier investors are getting involved with crypto. We're talking about institutional products like ETFs.
This is maybe the most important structural change for long-term adoption. The launch of these spot crypto ETFs, like the Bitwise XRP ETF, isn't just about making it easier to buy. It's about giving wealthy investors access to sophisticated capital management tools.
Specifically, something called an SBL.
Exactly. When they hold their crypto exposure inside a regulated ETF, they can then take out what's called a secured base line of credit, or SBL, against that equity.
Could you just quickly break down what an SBL is and why the ETF is the key to unlocking it?
Sure, an SBL is basically a low-interest loan from a bank that's secured by your stocks or mutual funds. The bank sees an ETF as a regulated liquid security they can use as collateral. If you just hold Bitcoin directly in a private wallet, a bank can't do that. There's no regulatory framework for them to recognize it as proper collateral.
So the ETF wrapper is what makes it bankable.
It makes it bankable. It allows these high net worth individuals to borrow against their crypto holdings without having to sell them, which is a core wealth management strategy that's now finally available for this asset class.
Let's also look at the people actually securing the network, the miners. We saw HIV Digital post a really strong quarter. What does that tell us about the economics of mining right now?
HIV's numbers give us a really clear window into the business. They scaled their operation massively, increasing their computing power from 6 to 25 exahash. That's a 300% increase in their network power.
Wow.
And their CEO detailed the key metric they use for profitability, something they call the bridge equation.
And what does that equation tell them?
It calculates their break-even hash price. The formula is their electrical price times their machine efficiency times 24 hours. That gives them the exact dollar amount the hash price needs to be for them to just cover their costs.
So where are they at right now?
Right now, HIV's break-even hash price is about $22, and the current market hash price is running around $36. So they have a very healthy profit margin, and that margin is crucial for them to be financially prepared for the next halving, because that event will instantly cut their revenue in half and push their break-even point way up.
Makes sense. And finally, let's just touch on XRP. It gets a lot of hype, a lot of wild price predictions. What's the more sober take from the analysis?
The consensus is very clear. You have to ignore the crazy price predictions. The sources specifically called out the $100 price targets that you see online as having no real foundation. The focus should be on realistic long-term accumulation.
So the use case is still there, but the price speculation is detached from reality.
That's the view. The core use case for cross-border payments is still strong, so analysts are emphasizing accumulation, especially at any price under the $2 level, as the smart strategy for anyone looking past the short-term noise.
Okay, so to bring this all together, it feels like the market is caught between these two huge forces. Internally, you have this incredibly intense cost-driven war in the AI sector, with giants like Meta and Google trying to find alternatives to being totally reliant on Nvidia.
And then externally, the timing of any big move up is purely a macro story. The data is clear that the next major rally for both big tech and crypto is pretty much completely tied to when the Federal Reserve decides to ease policy and pump more liquidity back into the system.
So the underlying demand is there for AI, for decentralized networks. It's, as one source put it, brimming. But the catalyst for a huge price move is still waiting on that fiscal policy shift.
Absolutely. And what's so fascinating to me is the difference in scale. You have these massive companies fighting over savings of, 84 cents per hour on computing. But the fate of the entire market, whether Bitcoin goes to $200,000 or not, still hinges on multi-trillion-dollar liquidity decisions made by a handful of people.
The micro versus the macro.
Exactly. That tension between the microscopic drive for efficiency and the huge macroscopic policy levers, that's what you need to be watching in the coming months.
Thanks for listening to this market recap on 15 Minute Investor.